Hello and welcome back to our inflation tutorial. Today we have a very important question. Is your country prepared for high inflation? And how do you assess this question? Now I'm going to show you a case study that I did about Germany for one simple reason. You can learn a lot about Germany's experience with high inflation. In the 70s there were a best practice example. But now, in my view, Germany could become the biggest inflation loser in the developed world. And I will explain to you why I have this concern. The first chart shows you why I said before Germany was a high performer or a best practice example during the 1970s inflation period. Here, the blue line shows you the inflation rate of Germany during the 1970s. And it's very easy to spot they were lower than the US, which is the orange line, or the UK, which is the grey line. The UK hit over 20% inflation back then. The US went over 10%, but this 10% was also very dramatic. Keep in mind, that was the time, 1973-74, the first inflation shock, and that was the time when the stock market, the S&P 500, lost 50% of its value. And then later we had another peak in the US in the late 70s, again over 10%. This was a dramatic time in the US back then. Unemployment rate went over 10%, we had severe recessions, and it was not a fun place to be. So, going forward, which countries are gonna win in inflation? Which countries are gonna lose? So if you think of inflation like a soccer game, what are the criteria? In soccer it's the goals that you score, but here it's the criteria that will determine whether your country is prepared for inflation or not. Before we go into this, I have one little ask for you. I want to continue this channel with free information for everybody. This is outside my work I do with corporates as a management consultant. I want to spread this important information and have a discussion going on. So please, you can support this channel either by liking it, so press the like button, but only if you really find these information and the videos that I present helpful, or hit the subscribe button, or share it with other people. Let's grow the community so we can exchange experiences and ideas. So please help me. It would be great if we can grow this important channel, because I want to help people understanding inflation. It's a very important topic. So let's come back to the 70s. Now I have added Italy to the picture. I do so because later I compare it to Germany with some charts, and it's very important to understand that Italy is probably a little bit better prepared right now. If we look at the yellow line, so it's almost like a UK situation, a terrible experience with inflation during the 1970s for Italy. Now you might ask, so why did Germany do so well and what was different? Now here are the reasons. The first one is the Deutsche Bundesbank. That's the German word for German central bank. And the German central bank was very, very different from many other central banks. They were really stuck with their clear and long-term principles. And one of the principles was, we will not tolerate high inflation. They also had a very clear and targeted communication strategy, and that's something we can learn from today. When you look in business media, on television, almost every day a member of a central bank board of any country is on the media talking about their personal views, and then the next day another member talks about the same topic, has a different view. And what does the market do? The financial markets go zigzag every time there's a new view presented. They confuse people, they confuse the economy. What was very important with the Deutsche Bundesbank was there was one communication strategy, and typically it was the head of the central bank who communicated, not every member who feels like it and goes out and have their own interviews. And therefore the Bundesbank was predictable, and that gave the Bundesbank a lot of credibility. The second point, very important, is high productivity. I talked about this in my previous videos. You have to understand, increasing productivity is a much better strategy to fight inflation, in my view, than just simply focusing on raising interest rates. For one reason, what does high productivity mean? That means that you create more output per unit invested, let's say in terms of time. So let's say in 1 hour you get more output in the production process. What does that translate into? Lower costs. And that's what we want to have for inflation. So the lower costs can be consumed, half of it, let's say, as more profit to the owner of the company, but also the other half can be given out in terms of lower prices for the products that have been produced. So you want to focus on productivity. I really don't understand why governments and central banks do not focus on productivity. That's the easiest way and the most reliable way to get inflation down again. You need to focus on productivity. Then another aspect in Germany was there were some laws in place that were geared at price control. But it's different from the price control that I talked about in other videos. What I do not recommend is during inflation times to start putting in price control from the government into the economy, to tell people or companies, you cannot sell this t-shirt for more than $10, right? The price is kept. In fact, they did something like this in the 1970s, inflation crisis in several countries, price control. That doesn't work. It has never worked in history. There's a book written, actually, I read this one, about 2000 years of price control failures during times of high inflation. It just doesn't work. You cannot selectively control here and there, and oil, we put another tax on the profits. It will not work. Don't do it. What was different in Germany, these price control measures were in place before inflation even hit. So therefore it was predictable. One was that rent can only be increased when you have certain conditions. And that was very tightly monitored. So you could not just say, like you have in some countries like the UK or in the US, where I have lived, your rent goes up by 10, 15, 20, 25% from one year to the next. That could not happen back then in Germany. And that helped to stabilize some pillars that are very important for the development of inflation, like rent, for example. So these measures were known to everybody, companies prepared for them, there was no surprise. Again, when you have price control from governments that comes out of the blue, that's bad because that disturbs the whole market mechanism. And again, we have seen it, it doesn't work. But here, that was something that helped contain inflation. The other one was a strong currency. A strong Deutsche Mark, which is the name for the German currency back then, helped to absorb some of the price increases. How does that work? If your currency goes up, and I show you on the next chart actually, it becomes cheaper for you to buy oil and other commodities that you need for the production process. So all imports become cheaper. When your currency gets weak, in economics we call that imported inflation, because then you have to pay more of your currency for a barrel of oil, for example. Imported inflation, again, is a bad thing. But Germany had a strong currency. And Germany had a strong education system. And this is a very important point. We always, in every country, we proudly talk about the education system and what we do for it. But back then that was different. The education system in Germany, on all levels, not only higher education and university or your PhD program, it was on all levels. also for the plumber or any craft that you were learning. It was highly organized and it was focused on teaching quantitative and practical skills. And the goal was to work on this one, on the productivity. So if we have an education system that makes people more productive, that works obviously in the productivity of the whole economy. So that was a very important thing. You might look it up if you're living outside of Germany, the dual system for any profession that you learn. The combination of school and working and apprenticeship is very successful model, and back then it also helped to keep the productivity at a certain level. So these were the reasons that, in my view, Germany did particularly well in the 1970s. Let's look into a little bit more detail on this one that I mentioned before, the foreign exchange side. This is the US dollar versus the Deutsche Mark. So the German currency to the US dollar. So it started in 1970 with $1 being 3.6 German marks. And then over the inflation period, the dollar deteriorated. It lost half of its value, and at one point of time it was around 1.6 Deutschmark. So that gave Germany an advantage because all of these commodities are accounted for in US dollar. So that was a help for Germany to buffer some of the inflationary pressures that everybody was experiencing back then. Now, when you look at this period here, that was the first inflation shock, and you see how the dollar basically crashed during that time. 27% were lost in several months. So that was one of the reasons that the US later had problems with imported inflation, because their currency got relatively weak. So again, if you're living in a country with a strong currency, that's actually a good thing during times of high inflation. Now this time it's different. And why is it different? Let me just explain to you where are the vulnerabilities for Germany. The first one today is we have low home ownership or house ownership. The ratio in Germany is around 50%. That's a big issue because 50% of Germans will rent, and rent will go up with inflation. That will put another pressure on them. Even worse, if you don't have house ownership, you most likely don't have a mortgage. And here's the trick with inflation. When you have a house or an apartment and you have financed it with a long-term fixed rate mortgage, you can win in typical inflation periods twice. First, your house goes up in value and the value of your mortgage in real money goes down. That's a very important point to keep in mind. So countries that have high home ownership and have a lot of fixed rate mortgages will have a certain advantage because of this, I can call it double dip. You know, you win because your house is a real asset and the price might go up substantially, and your mortgage, the value of your mortgage goes down. And even better, most of these mortgages in the last years before inflation hit were taken out at ridiculously low interest rates, right? But that's not all. Germany also has in general low indebtedness. That means Germany, the German government for example, strongly believed in fiscal balance. So don't take too much debt. And the same also for companies. They were always trying not to go crazy with indebtedness. And that's an issue because debt gets inflated away. So if you use the debt to buy a house as a person or to invest in another factory as a company or as a government to invest in infrastructure, as long as you invest the debt that you take out in productive activities, it might be a significant advantage. because the debt goes away and later you get the results in real money on the inflated level. So that's something that's not available to the Germans. The other thing is also interesting, the investment preferences of Germans. They have very low stock ownership. People in Germany for the longest time prefer savings accounts or a saving product that combines a savings account with a life insurance policy, but relatively low stock ownership. And that makes them vulnerable for two reasons. First of all, the Germans did not create a wealth effect like in the US, like retirement accounts that went up because people invested in the stock market. People in Germany invested in savings account. So the wealth effect was not there. But now going forward, the savings account gets inflated away. I'm not saying, by the way, that stock ownership is the best thing for inflation. There is a video on this that I made that explained that in the initial phase of an inflation period, stocks very often do not very well. Warren Buffett knows that because he kept cash going into the inflation in the 70s and then bought when stocks were very cheap. But for the past, the stock ownership gave you a significant boost in terms of wealth. The German austerity policies we have talked about. There's a backlog of infrastructure investments. You hear it now from Germany. They want to invest in the military system, in the schools, in the infrastructure, streets, bridges, internet, and so on. So they will now have to do these investments that they didn't do in the past because of austerity, with one difference. Now interest rates are higher on the debt that they need to take out, and the costs will be higher. If you are building a house or renovating, you will see that now prices are way higher than they were 2 years ago. So unfortunately, Germany runs into that situation now that in the past, because of negative interest rates, they could have had free financing. In fact, they would have gotten paid for taking out debt due to negative interest rates. And that was the situation that they didn't take advantage of. And now they have to invest in a time when interest rates are going up and everything you buy due to inflation will get more expensive. Now another point for Germany is very important, and that's something you should check for your own country. If you live in a country with a steep tax progression, that's very challenging in a time of high inflation. In Germany, when you earn more money, your tax rate goes progressively up. It goes over proportionally up. And that's a big issue for inflation because, yes, you will get higher salaries most of the time. However, that will not offset the inflation for your living expenses. But in Germany, people have the problem that with the higher salaries, they also pay higher taxes. So a lot of the salary increase that was thought to fight inflation is actually going to the government in form of higher income taxes. So that's a very important point to keep in mind. Now let's look at the comparison to other countries. I mentioned the home ownership, and I want to show you how dramatic the difference is. You remember we talked about Italy, a loser in the 1970s inflation period, very high inflation rates, staying high for a prolonged period of time. Now going into the next phase of the next inflation crisis, it looks a little bit different. Home ownership in Germany, the second lowest, around 50%. That means 50% of Germans roughly are renting and are getting hit on this. And they don't have the advantage of the mortgage that gets inflated away. In Italy, we have over 70% home ownership. That's a dramatic difference. In Greece, it's even higher, and in Spain as well. And in Poland, very interesting, over 80% home ownership, according to this analysis that I found, the statistic that I found on the internet. So that's a big disadvantage for German people going forward. going into this inflation crisis. Let's go one step further. I told you the government debt to GDP ratio in Germany is relatively low. The US is over here, it's much higher, way over 100%. Now, this is something you have to learn. Debt is normally not a good thing to be overly in debt, except for times of high inflation. In high inflation periods, debt gets inflated away. So that's the interesting thing when you work with companies on inflation management topics. Managers have to relearn. A lot of things that went well in the past, that worked in the past, will not work in an inflation environment. So for example, having a decent amount of debt that was not excessive was good in normal times. But in inflationary periods, you might have considered to make these investments in real assets with debt because your debt gets inflated away. So Germany has now the problem that they have these infrastructure investments and the school investments, education, military and so on at a time when debt gets more expensive. So they don't have this advantage if they did it in the past, that the debt was already issued at a very attractive price and it would be now already partly inflated away. Now they have to invest into a high inflation period. That's not a good timing actually. Now the equity ownership, again I mentioned to you, Germans like savings account or life insurance policies with a savings account attached or similar products. The stock ownership is very low in Germany. Even though the German index did very well over the last 20 years, but most of that advantage went to foreign investors that invested in German listed companies. So you can see here's Germany around 10%, and almost all countries have higher stock ownership. Again, I'm not saying that going into inflation you should be in stocks. Please watch the video. In the initial period that can be a little bit tricky. Now let's summarize this. Why is now Germany, if you're living in Germany, is it a difficult time due to inflation? And please take these criteria and check them for the country you are living in, right? I explain them for Germany, but you can do the same analysis for your own country. Now the first point is the Deutsche Bundesbank is not in charge anymore to set exclusively monetary policies. It's the European Central Bank right now, and they have a very different policy than what the Bundesbank used to have in the 1970s. So that's one point why I think Germany will not do that well in the next inflation crisis as they did in the 70s. The second one I talked about is the low indebtedness. That doesn't help neither the people nor the companies nor the government to use inflation to inflate away part of the past debt. Now the population has, the people in Germany have different issues to deal with. Low home ownership, rising rents, savings accounts have already suffered a lot in the last 10 years after the last financial crisis due to very low or practically zero interest rates. But now you have an even bigger issue that inflation will eat more and more of these savings away, and you have to struggle with the steep tax progression. I also said that Germany unfortunately missed the opportunity to finance at very attractive rates all the infrastructure investments that they are now deciding to do in the future. If they had done it already 5 years ago when we had negative interest rates, that would have been, from a financing perspective, attractive, but also from an inflation perspective, very attractive. The other issue that I didn't talk about is the energy costs. Because of the structure of the energy market, energy already is very costly in Germany, and unfortunately with high inflation, that's one point that is probably getting even more expensive in the future. And the last point, that's one point that I also want to mention here, that's not only for Germany, but it could hit Germany as well. During times of high inflation, people gravitate to extremes in their political convictions. We have seen that in the 1920s hyperinflation period. Unfortunately, there was a lot of polarization. At the end, there were people either at the left or at the right, and that basically ruined the first German experiment with democracy, the Weimar Republic. So unfortunately, this is the case, and that's in every country. You have to be careful. High inflation will be used by political demagogues or people who are populist, and there will divisive measures that will happen. They will attack the current governments, attack the system, and so on. And that's very dangerous, and you have to make sure that people are educated about inflation and they don't fall into these easy manipulation attempts by people who do not mean well, right? That's a point that we have to keep in mind. So, to sum it up, my personal view is that Germany did extremely well in the 1970s, but now we are in a completely different situation in Germany because of the criteria that I described in my video. You can compare your situation to these negative points that Germany is facing going into this inflation crisis. But in my view, Germany could actually be one of the biggest, in relative terms, one of the biggest inflation losers in this period that we are going into. I hope you enjoyed this video. Again, if I may ask you, like it, push the like button, push the subscribe button, then you become part of the network and you get notified when new videos come out, or share it with friends. That would be very helpful to me too. If you do that, and the channel could grow and could reach more people. If you have any comments, feel free to add them in the comment section. I will do my best to respond to every comment. Thank you very much and good luck beating inflation.